Arnaud de Servigny, thanks very much for joining us. Arnaud, can you tell us how the events of the last 5 years have changed the investment landscape for portfolio managers?
Well, in fact, when you're looking at the quant approach, you are thinking of laws of nature, stability of relationships. And what we've seen is that some relationships hold for a period of time, some change. And in fact, there is not the stability that you find in the nature. Human nature is not as stable. In fact, you have got some crowd effects and things like that that trigger change of behaviors and change of relationships, and that needs to adapt. When you're running a quant model, you need to have some history, track record, etc., to identify these laws of nature. And think of what has been happening, say, 10, 15 years ago. Is that fully relevant to be able to infer what could be happening during 2008 or just now? Maybe not fully.
Can you describe the benefits of a behavioural finance approach for investors?
Well, in fact, when you're looking at the markets, you're looking at prices. The way I would look at them is perhaps a bit different in the sense that in order to have a market, you need to have buyers and sellers. And in a way, when you look at the buyers and the sellers, there are the private buyers and the private sellers, there are the governments, there are the banks, etc. There is some sort of communicating vessels there. And in fact, so you can see that as a game between different players. And the behavior of some of the players will impact the prices. So if you find some private investors becoming shy because they're worried, that will have an impact on the flows, that will have an impact on the prices. If some of the banks, like we've seen, are not working as well, to say the least, as they were before, that will have an impact on the formation of prices.
So in your view, managing portfolios for clients and investors has become more inclusive in pulling together different philosophies, that it shouldn't just be pure quant, we need to pull in other ideas.
Yeah, what I would say first is that the quant approach is always very interesting and is always a good background to have in mind. Now, there is one thing that has been taking place, which is that at the end of the year 2000, what we have had is we've had some academic publications telling us that there was no magic in quants. That in fact, the paper I'm thinking of is a paper by some of the colleagues at London Business School about the fact that an equally weighted portfolio was probably doing better than a mean variance optimized portfolio. So that means that it triggers some sort of a need for some humility here, and also understand the fact that, as I said, laws of nature are not forever and that we need to adapt.
Arnaud, can you give some advice to the traders and the fund managers in the audience? Should they be looking at their emotions more closely when they're making investment decisions?
I think they should, and I think that sometimes they need to be aware of it, not to fall into traps. In the sense that there is something that is very clear in our mindset, is that we tend to think in terms of stop losses. When we start losing money, we want to cut risk. And when we're in markets that are what is said in the jargon mean reverting, that means that they come back if you've cut your position at the bottom and you're not doing the right thing. Or if you buy on the basis of regret because you see markets going up and you haven't been invested sufficiently early, in the end what you end up doing is buy high and sell low.
So Arnaud, do you think that academics and professional investors should actually trade ideas more often?
What you have is you have the impression that it has become very technical, very quantitative, but in reality, what is underpinning the way people have been building portfolios was based on Markovitz's Black Letter Man and things like that. And Markovits was at a time where television was black and white, so it's quite old. So we need to rethink what we're doing, learn and leverage new understanding of the science, and evolve and improve. And in fact, what has become very important in my view among professionals is to ramp up the quality of their investment processes. And investment processes and being rigorous on how you do things doesn't mean that you're just quant, but means that you really understand what makes sense and what doesn't make sense, and therefore, in order to be at the forefront of investment processes, you need to be able to leverage the findings of the academic universe.